Traders dismissed Saudi Arabia's announcement of voluntary further oil output cutbacks back in July. Prices were static. Everyone was focused on the US and Chinese markets' need. The situation has drastically changed 3 months later. Russian and Saudi officials jointly announced a 3-month extension of their cuts. The focus of forecasters shifted to supply. As it turned out, there was already a tight supply due to high demand, which made the imbalance worse. If only someone had anticipated this. Only many could have predicted this. First, greater oil prices were necessary for both Saudi Arabia and Russia. Second, unlike past occasions when OPEC Plus reduced production to raise prices, there was little chance that US shale would increase production in response. The US shale industry is pleased with its new, more methodical approach to production expansion and is taking it carefully rather than adding rigs as soon as WTI increases in price. Another reason why no one is racing to the drilling rigs in this situation is that US drillers are still experiencing significant cost inflation and anticipate that it will continue into next year as well, according to the Dallas Fed Energy Survey released this week. Therefore, Saudi Arabia and Russia virtually had a guaranteed bet because the fundamental challenge of US shale jumping up and filling the gap left by those 1.3 million barrels daily was eliminated. According to an analysis by Energy Aspects that was cited by the Wall Street Journal, Saudi Arabia's oil export earnings could increase by $30 million per day this quarter compared to the previous one. That is an increase of $2.6 billion or 5.7% compared to the second quarter. The research also predicted an increase in oil income to Russia of $2.8 billion throughout the time frame. Russia's oil and gas income might total $7.6 billion in September alone, according to a separate calculation by Reuters. This would represent a 14% increase above revenues for August. The move by Saudi Arabia and Russia was described in the Wall Street Journal piece as dangerous. It might have been in different circumstances. When one producer cuts back on their output, another usually fills the void. Or the price reductions merely have no effect, as was the case with the Saudis in July. But then something happened. No other producer was able to step in and replace the void Saudi and Russian oil left, as was previously mentioned. Nobody did. The cuts performed their job, driving prices higher and continuing to do so despite a minor delay. Due to the demand, the International Energy Agency provided 2 updates on the demand for oil during the past 2 weeks. The first predicted that the peak in oil demand would occur before 2030 as a teaser for its world energy outlook. The demand for gas and coal would peak as well, with the destiny of its successors, wind, solar, and EVs, being determined. This occurred 2 weeks ago. The International Energy Agency last week released an updated version of its roadmap to net zero, which stated that by 2030, the world's demand for oil must decrease by approximately a third. To put it another way, it wasn't going to decline on its own, but it had to if we were to keep the globe on the net zero path. Saudi Arabia and other oil producers did not like the IEA's message. The kingdom has often cautioned that there has not been enough investment in new oil and gas supplies, and that messages like the IEA's run the risk of lowering investment appetite even further, endangering the security of supply. In fact, shortly after the IEA's P.R.O published the FT's first report on oil demand, Christian Malik, head of energy equity research at J.P. Morgan, predicted a volatile supercycle for hydrocarbons, with $150 per barrel for crude not out of the question. Additionally, he predicted that the supercycle will force oil prices to remain above $100 until the end of the decade due to a shortage. It is insufficient to predict the peak in oil consumption and then assert that the peak has already occurred. That is the responsibility of actual demand, which usually starts to decrease as soon as prices rise too much. Therefore, the only issue is determining what price is excessive. I believe that in order to shift consumer driving patterns and destroy demand, crude oil prices must reach $100 to $110 per barrel and gasoline prices must reach $4 to $4.25 per gallon. This month, Andy Lippo from Lippo Oil Associates told Yahoo News, "We do anticipate that there will be severe demand destruction at WTI prices above $95 per barrel, which will force the commodity down into our fair value range." This isn't a universal truth, though. It might not even be entirely accurate. Whatever the cost of a gasoline gallon, people will still drive if they need to. India is a prime example. Even though experts projected a downturn in the second half of the year, demand for oil has increased in India despite higher costs. Regardless of where prices are heading, it looks that it will continue to grow as the holiday season starts in the latter months of the year and also the following year. With their cuts, the Saudis and the Russians may have run a small but calculated risk. The only real question is when demand starts to be undermined by high prices because of how resilient oil demand is, which continues to guarantee the effectiveness of such actions. The war premium that formed following last weekend's attacks by Hamas on Israel began to diminish this week as stockpiles increased and countries made a clear effort to control the violence. As a result, crude oil prices are expected to rise modestly this week. According to Reuters, Brent crude is expected to close the week up 2.3% while West Texas Intermediate is expected to gain 0.8%. The evident intention to stop the most recent outbreak of violence in the Middle East and prevent any further escalation was one of the factors contributing to the rally's brief success. The U.S. military has been placed on notice as a strong deterrent to other countries becoming involved in the crisis, and President Biden has been unambiguous in his support for Israel. He has also highlighted how crucial it is for Netanyahu and Israel to adhere to the laws of war. The enormous increase in oil inventories that was revealed this week by the American Petroleum Institute and the Energy Information Administration also played a part in controlling oil prices. The build was assessed at 10.2 million barrels by the EIA and 13 million barrels by the API. Separately, the International Energy Agency said that despite an agreement with Riyadh to cut oil shipments by 300,000 BPD, Russian crude oil and gasoline exports had increased in September. The IEA reports a 460,000 BPD increase in Russia's crude oil and gasoline exports from August to September. Since then, Russia's deputy prime minister has asserted that the commitment to cut oil exports by 300,000 BPD also applies to oil products. Since the U.S. stopped the delivery of $6 billion to Iran as part of the prisoner swap arrangement and said it will look into whether Tehran was involved in the preparation of the Hamas attacks, all eyes are on Iran in the meantime. Iran has refuted all claims. The U.S. also imposed its first penalties on two owners of tankers that have been shipping Russian crude oil overseas, stating that the oil they shipped had been sold for more than the $60 per barrel ceiling the G7 and the EU had set for Russian petroleum. This increased the potential for oil to rise, as did OPEC's most recent monthly report, which showed that the demand for oil remained steady. The IEA's monthly report, which highlighted the tight oil supply situation, served to exacerbate the effect. Geopolitical danger and tight oil markets will keep traders on edge for the foreseeable future, but amid economic uncertainty, demand worries and rising stocks continue to pressure oil prices. Amin Nasser, chief executive of Saudi Aramco, stated on Tuesday that the world and the COP28 climate summit should concentrate the discussion on how to reduce emissions rather than lowering oil and gas production. Emissions should be the main concern. The senior executive of the largest oil company in the world was reported by Reuters as saying at the Energy Intelligence Forum in London that we need to either shut down or slow down big time your conventional energy. Today's focus is not just on emissions. OPEC Secretary General Haytham Al-Ghaz stated earlier this month that OPEC and leaders from the oil industry would attend the COP28 climate summit in Dubai. Al-Ghaz remarked last week, "I hope all voices will be at the table at 28 Colombian pesos." Aramco's Nasser stated that the Saudi oil giant is working on renewables, e-fuels, hydrogen, and carbon capture and storage, CCS, today at the Energy Intelligence Forum. However, he went on to say that the world would still want oil and gas for many years to come. In order to counterbalance the 5 to 7% annual drop rates caused by the increased oil and gas demand over the next 10 years, Nasser underlined that fresh upstream expenditures are required. The CEO of Aramco continued, "We need improved communication between industry and COP delegates as industry is the only one capable of bringing new or old energy solutions. You need a large and diverse supply of countries in the energy transition because you don't want to go from fuel dependence to material dependence," according to Nasser. Sultan Ahmed Al Jaber, the UAE's Minister of Industry and Advanced Technology and the group CEO of Abu Dhabi National Oil Company, ADNOC, one of the largest national oil firms, has been named the 28 Colombian pesos president-designate. This sector of the economy must lead the way in finding answers. Al-Jaber remarked at the opening of the ADIPEC Energy Conference in Abu Dhabi earlier this month that this industry has been perceived as a contributing factor to the issue for far too long, that it is not doing enough, and in some circumstances, that it is even obstructing development. What are your thoughts on Saudi Arabia and OPEC+, and do you think they can collapse the US economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching and I'll see you in the next one.